All right, Gregory B., welcome to the deep dive. You wanted to unpack ESOPs, and honestly,
Yeah.
I gotta say, these things are pretty fascinating. It's not just retirement plans, right?
Right.
We're talking potential tax benefits, how to generate capital, maybe even a bit of employee ownership, all rolled into one neat little package.
Yeah.
So let's dive in.
Sounds good. You really hit the nail on the head there.
Yeah.
ESOPs, or employee stock ownership plans.
Right.
They are a really unique blend of, like you said, employee benefits and corporate finance. They can offer some real advantages.
Yeah.
But the rules, they can be complex.
Well, that's why we're here,
Yeah.
to break it all down.
Yeah.
So, for anyone listening who might be new to all this, can you give us like a quick rundown of what an ESOP actually is?
Absolutely. So at its core, an ESOP is a type of retirement plan, but what really sets it apart is that it primarily invests in the stock of the employer company. It's kind of like a built-in way for employees to share in the company's success.
Okay, that makes sense.
Yeah.
But I know there's a lot more to it than just that.
Yeah.
Where do these tax benefits come in? You know, the stuff that gets me really excited.
Yeah. Yeah. The tax advantages. So ESOPs offer benefits for both the employer and the employees.
Okay.
For example, employers can often deduct contributions they make to the ESOP. And employees, they typically don't pay taxes on the contributions or the earnings until they withdraw the funds in retirement.
So it's kind of a win-win. I knew there was a reason I was so intrigued by this.
It can be, but the rules, they can be very specific. And to be honest, sometimes a little quirky. For example, did you know that employees who have been in the plan for at least 10 years and are 55 or older, what we call qualified participants, have some say in how a portion of their account is invested?
Interesting. So they're not like completely locked into company stock. That seems like a good thing, especially if someone's, nervous about having all their eggs in one basket.
Exactly. It provides some diversification and control for those longer-term participants.
Right.
And there are rules about how and when those funds are distributed, especially when an employee leaves a company.
Right.
But what really piqued your interest, and what we'll get to later with the Berman case, is the tax breaks for business owners selling their stock to an ESOP.
Oh, yes. The tax deferral strategy, that's the stuff I live for.
Yeah.
Before we get there, can you give us a bit more background on how these ESOP rules actually work?
Of course. The foundation for all of this is laid out in the Internal Revenue Code.
Okay.
Specifically, Section 409. This section sets the ground rules for what an ESOP can and cannot do.
So it's not just like a free-for-all.
Right.
There's actual legislation behind it.
Exactly.
What kind of stuff does Section 409 cover?
Well, it covers a lot, but some key aspects include those rules we just talked about regarding qualified participants and distributions. It also mandates that participants have the right to receive distributions in the employer's securities.
So they have the option to actually own a piece of the company, not just, cash equivalent to the value of their stock.
Yeah.
That's pretty cool.
It is, and it really gets to the heart of what ESOPs are about. But back to those juicy tax deferral rules you're so interested in.
Oh, yeah.
If a business owner sells their stock to an ESOP under certain conditions, they might be able to defer paying capital gains tax on that sale.
Now, deferring taxes, that's music to my ears. What are these certain conditions you speak of?
Well, first they have to make a formal election with the IRS, letting them know they intend to use this deferral strategy.
Okay.
This is done using a Form 1042.
Okay, so paperwork's involved. I had a feeling.
Then they have to reinvest the proceeds from that sale into what's called qualified replacement property, or QRP for short.
Okay. So they can't just take the money and run off to a tropical island.
Not exactly. They have to put that money back into certain types of investments that the IRS approves. Usually things like stocks and bonds.
So the government's encouraging reinvestment to keep the economy humming.
Right.
Makes sense. What are the other requirements?
There are two more. First, the gain from that sale would have to be a long-term capital gain if they hadn't sold to the ESOP. Basically, you can't use this strategy to avoid taxes on short-term gains.
So it's really designed to benefit those who have held onto their stock for a while.
That's the idea. And finally, and this is where things can get tricky, the ESOP must own at least 30% of the company's stock after the sale.
30%? That seems
Yeah.
pretty straightforward. What's so tricky about that?
Well, the IRS uses these things called attribution rules to determine ownership.
Okay.
And it's not always as simple as just counting up shares.
Okay. I could already feel a headache coming on. Can you give me an example?
Sure. Let's say a company has stock options outstanding. Even if those options haven't been exercised yet.
Okay.
They can still be factored into that 30% ownership calculation.
So it's not just about who currently owns the stock.
Right.
But who potentially could own it down the line.
Exactly.
That does add a layer of complexity.
And this 30% threshold is crucial. If the ESOP doesn't hit that mark after the sale, the seller, they lose the tax deferral benefit entirely.
No capital gains holiday for them. Ouch. I'm starting to see why this stuff can be so complicated.
It definitely requires careful planning.
And if I'm not mistaken, you mentioned earlier that C corporations actually don't get this tax break. How does that work?
Good catch. It might seem unfair, but C corporations have a different advantage.
Right.
They don't recognize gain or loss when they sell their own stock.
Interesting. So it's like a different path to a similar outcome.
Exactly.
It sounds like there's a lot to consider here.
There is, and it's important to understand the implications of every decision. Which brings us to the Berman case.
Yes. The Berman case. I've been waiting for this. Before we get into that, let's take a quick break to hear a word from our sponsor. This program is brought to you by iFindTaxPro, where tax and legal compliance are made clear and management of client communication simple. iFindTaxPro.com is a platform for professionals and their clients, open to everyone. And don't forget, we love hearing from our listeners. If you have any questions about ESOPs or any tax topic for that matter, send them our way. We might just feature your question in a future deep dive.
All right, so the Berman case.
Yes.
This case decided in 2024.
Okay.
It's a great example of how even the most well-intentioned tax strategies can have unexpected consequences.
Okay, set the stage for us. Who were the Bermans and what were they trying to do?
So Edward and Annie Berman, they owned stock in a company.
Okay.
And like many business owners, they were looking at ways to potentially reduce their tax burden when they sold that stock. So they decided to sell a portion of their stock to an ESOP, specifically to take advantage of those tax deferral rules we were just talking about.
Sounds like a smart move.
Yeah.
Did they follow all the steps correctly?
Yeah.
Did they make the election, reinvest the proceeds?
Yes. Initially, they did everything by the book.
Yeah.
They filed Form 1042, indicating their intent to defer the gain. And they reinvested the proceeds from the sale into qualified replacement property, in this case, floating rate notes.
Okay.
Everything seemed to be going smoothly.
But I'm sensing a but coming. Where did things go sideways?
Well, here's where it gets interesting. The Bermans used those floating rate notes, their QRPs, as collateral in a separate transaction. And this is where things took an unexpected turn.
Okay.
The tax court ultimately determined that the way this transaction was structured, even though it was presented as a loan, was actually more like a sale.
Wait, so even though they technically still owned those notes,
right,
the fact that they used them as collateral in this other thing triggered the IRS's disposal alarm bells.
Precisely. And remember that recapture rule we talked about earlier?
Yeah.
The one that says, if you dispose of your QRPs before certain timeframes have passed, you have to recognize the gain you were trying to defer.
Right.
Well, that's exactly what happened to the Bermans.
So even though they hadn't fully sold those notes and were still receiving payments on them, the tax court said, nope, this looks like a sale to us, and you triggered the recapture rule.
Yes.
That seems a bit harsh.
It might seem that way, but the court was looking at the substance of the transaction, not just the form.
Okay.
And in their view, this particular arrangement, it crossed the line from a loan into a sale.
Okay, so the Bermans messed up.
Yeah.
But what did that actually mean for them in terms of taxes? Do they have to pay the entire deferred gain all at once, even though they hadn't received all the money from the original sale yet?
That's the question that went all the way to the tax court. The Bermans argued that they should be able to use the installment method to spread out the gain recognition.
Okay.
Which made sense since they were still receiving payments on those notes over time.
That seems fair. What did the IRS say?
The IRS, of course, took a harder line.
Okay.
They argued that the Bermans' Section 1042 election, their choice to defer that gain in the first place, took precedence over the installment method.
Okay.
Their position was that the entire gain had to be recognized right then and there, regardless of when the Bermans actually received the cash.
Wow. So it was a real showdown between two different sections of the tax code, the deferral rules versus the installment method?
Who won?
I'm on the edge of my seat here.
This is where it gets really fascinating. The tax court actually sided with the Bermans.
Wait, they did? How is that possible? Didn't we just establish that they messed up by triggering the recapture rule?
They did trigger the rule, yes.
Okay.
But the tax court found a way to reconcile the two sections of the tax code, essentially saying that they could work together.
Okay, I need you to, break this down for me because my head is spinning a little. They triggered the recapture rule,
Right.
but they still won.
Yes. It seems counterintuitive, but here's the key.
Okay.
The tax court zeroed in on specific language in Section 1042A,
Okay.
which refers to the gain which would be recognized. They interpreted this to mean that Congress, when writing these rules, was aware of the installment method and intended for the two concepts to coexist.
So even though the Bermans had to recognize that deferred gain, because they technically disposed of their QRPs, they could still spread out the pain of paying the taxes on that gain as they received the installment payments.
Exactly. It was a victory for nuance and a reminder that even seemingly straightforward tax strategies can have unexpected twists and turns.
Man, this whole case is making me sweat. It seems like you need a law degree just to understand how these ESOP rules work, let alone actually use them.
You're not wrong. It highlights the importance of working with experienced professionals who understand the complexities of ESOPs and the tax code.
Yeah.
Even seemingly small decisions can have major consequences down the road.
Well, this has been enlightening, to say the least. What about the ESOP itself? What happens on the ESOP side when a transaction goes awry like this?
That's a critical question and often overlooked. Remember, ESOPs frequently use borrowed funds to purchase company stock.
Yeah.
If the seller who essentially pledged their replacement property as security for the ESOP's loan disposes of that property prematurely, it could create a precarious situation for the ESOP.
Right. It's like a domino effect.
Yeah.
The seller's actions can, ripple outward, potentially impacting the financial stability of the ESOP.
Right.
And ultimately the employees who are relying on it for retirement.
Exactly. And this raises a whole host of concerns regarding fiduciary responsibility, risk management, and the potential for unforeseen consequences when complex financial transactions intersect with employee benefit plans.
So, Gregory B., if you're exploring ESOPs, this case, it really underscores the need for careful consideration.
Yes.
And expert guidance. But beyond the legalities, what are some of the broader implications of ESOPs, both for businesses and employees?
That's where things get really interesting. ESOPs, when structured effectively, can be a powerful tool for business succession planning. They allow owners to transition ownership to employees gradually, ensuring continuity and potentially preserving the company's legacy.
That makes sense. It can be a win-win for both sides. The owner gets a fair price for their business, and the employees gain ownership and a vested interest in the company's success.
But what about from the employee's perspective? Are there any downsides to having your retirement savings tied so closely to the company you work for?
That's an important consideration. While ESOPs can offer tremendous benefits, they also carry inherent risks.
Right.
If the company's value declines, so does the value of the employee's retirement savings.
Yeah.
This lack of diversification can be concerning, especially if the company faces financial challenges.
So it's not a one-size-fits-all solution.
It really depends on the individual company, its financial health, and the employee's risk tolerance.
Absolutely. And that's why education and transparency are so crucial.
Yeah.
Employees need to fully understand how ESOPs work, the potential benefits and risks, and how their participation might affect their overall financial well-being.
Well, Gregory B., I hope this deep dive has provided you with valuable insights into the complex world of ESOPs. It's a fascinating topic with both tremendous potential and some significant considerations to keep in mind. If you have any further questions, please don't hesitate to reach out.
We're always here to help.
And to everyone else listening, we'd love to hear from you too. What are your experiences with ESOPs? Have you encountered any unexpected twists and turns in your journey with employee ownership? Send us your questions and thoughts. We might just feature them in a future episode.
Learning from real-life experiences is the best way to navigate these complexities.
This program is brought to you by iFindTaxPro, where tax and legal compliance are made clear and management of client communication simple. iFindTaxPro.com is a platform for professionals and their clients, open to everyone. Thanks for joining us for the deep dive. Until next time, keep exploring and remember, knowledge is power.